The difference between traded REITs and non-traded REITs is that traded REITs are listed on a public exchange. So for example, a REIT might be traded on the New York Stock Exchange, and the positive aspect of being traded on an exchange is that you have immediate liquidity. And one of the negative aspects of being traded on an exchange is you have volatility. Non-traded public REITs are REITs that are not traded on exchange but are publicly registered. As such, investors typically don't have the volatility that they would experience if they invested in a REIT that is traded on an exchange. They generally generate cash flow that is a little bit higher and more consistent than those that are traded on a stock exchange. However, the challenges of non-traded REITs is that they are not nearly as liquid. So investors have to think carefully about their portfolios when considering whether or not a non-traded REIT is right for them. In many cases, they act more like buying real estate. When you buy a piece of real estate, you acquire it, you hold it, you garner some cash flow for the time period that you hold it, and then you sell it. Non-traded REITs act that way. A traded REIT can be traded daily. You can buy it today and sell it tomorrow. That's not really how real estate works. So when you invest in a traded public REIT, you're investing really in more of a company that is acting more like a company that you would acquire through any sort of investment, and non-traded REITs act a lot more like real estate.
To get the whole series of 26 one-minute videos that answer your most important questions about commercial real estate, visit theheritagegroup.com/tips.